The nail is still in the wall. Whoever lived there before him left it, a single finish nail, barely 2 inches high, slightly off-center on the living room wall. He stands in the empty room with a cup of coffee going cold in his hand, boxes still stacked by the door, and through the window he watches his friend Tyler's moving truck idle in the identical driveway next door. Same street, same year, same 30-year loan, signed an hour apart at the same bank. Nobody watching these two men unload their trucks that morning could tell you which one of them will own his house free and clear by 50, and which one will still be paying it off at 74. The gap between them has nothing to do with income. It comes down to one decision Tyler is about to make, and he is not. The kind nobody notices until it becomes either the quiet position or a debt that outlives a career. This is the story of that decision, and the number waiting on the other side of it, 21 years later, that neither of them saw coming. He hangs a photo on the nail. That's it. That's the whole decision. He calls the bank that afternoon and sets up an automatic transfer, an extra $150 a month, straight to principal, on top of the regular payment. Nobody told him to do it. He didn't run a spreadsheet. It just felt like the right use of the small amount left over after the bills. He doesn't mention it to anyone. There's nothing to mention. It's a Tuesday. Next door, Tyler is standing in his identical kitchen, looking at the same linoleum, the same, not quite open floor plan, the same paint the last owner left behind. It isn't dissatisfaction exactly. It's the gap between what the house is and what he already decided it should be. By month 2, he's pulled a home equity line of credit against a house he's owned for 8 weeks, $24,000, and a contractor is tearing out his kitchen. Both men are paying $1,139 a month on a 30-year mortgage at 5.9%. Both make about the same, give or take, one of them in project coordination for a logistics company, Tyler in sales, somewhere he'll change twice before this story is over. Neither is ahead, neither is behind. The starting line is dead even. Except it isn't, because Tyler just added $24,000 of debt to a house he barely owns, and his neighbor just quietly started pulling his own payoff date forward, 1 month at a time, without a single person clapping for it. Here is the part almost nobody explains at closing. A 30-year mortgage runs almost entirely on interest in the early years. In year 1, nearly $900 of that $1,139 payment goes to the bank, not to the house anyone thinks they're building equity in. An extra $150 a month doesn't look like much against that. It won't move the needle this year. It barely moves it the next. But it's already changing the math the loan runs on, quietly, in a column nobody reads. Tyler's HELOC is changing a different kind of math. It's not just a second payment stacked on top of the first. It's a pattern. It teaches a house to be a place where the distance between wanting something and borrowing for it gets shorter every time you do it. None of this makes Tyler reckless. He isn't irresponsible, and the kitchen genuinely looks the way a kitchen should look when he's done with it. New floors, new cabinets, an island that opens the whole space up. He stands in the middle of it, and it finally feels like his. That feeling is real. It's also $24,000 plus interest on a house he's owned for 2 months, and both of those things are true at the same time. If any of this is landing so far, a like takes about 2 seconds, and it actually helps this reach the people standing in a kitchen, deciding the same thing right now. The call comes in the spring of 2010. A realtor, someone Tyler's coworker mentioned at a barbecue, the kind of person who talks about school districts the way other people talk about weather. The market's come back. Tyler got a real raise last year, first one since before the crash. There's a development 2 zip codes over with better ratings and bigger lots. He does the math on a napkin, and it works, so he says yes. Here's what the closing table never mentions. Every time a house gets sold and another one gets bought, somewhere between 8 and 10% of its value simply disappears. Not into equity, not into the new place. Gone. Agent commissions run 5 to 6%. Closing costs, title, insurance, transfer taxes, escrow, tack on another 2 to 3. On a house worth around $210,000 in 2010, that comes out to somewhere between $16,000 and $21,000, spent before Tyler spends a single night in the new house. Think about what 5 years of $1,139 payments actually built. Just over $68,000 sent to the bank. And because those early years run almost entirely on interest, the real equity underneath that is closer to $14,000 or $15,000. The moving costs alone wiped out nearly everything Tyler had built. He walked out of one house and into another and landed, financially, almost exactly back at the starting line he thought he'd left years ago. Call it the reset tax. Nobody puts it on a receipt, but it's the most reliable bill in the whole business of moving up. Nothing happens next door that spring. No realtor, no closing table, no wire transfer to a title company. The nail is still in the wall. The linoleum is still on the floor. The $150 still goes out on the 3rd of the month, the way it has for 5 straight years. And nobody notices, because there's nothing to see. The balance is lower than it should be for a loan this age. The interest portion of every payment has been quietly shrinking, because the balance it's calculated against keeps shrinking under it. He's ahead of a schedule that doesn't show up on any statement, in a race nobody told him he was running. If you're not subscribed yet, this is a good moment for it. New videos every week, and the next one picks up right where this math gets interesting. Rates fall to 2.9% in the fall of 2020, the lowest anyone alive has ever seen on a 30-year fixed. Tyler's phone won't stop buzzing about it. His financial guy leaves a voicemail saying the window won't stay open. He's been in the second house 10 years now, and it's fine. Better than fine. But there's a new development 12 minutes away with the open floor plan he's wanted since he gutted that first kitchen back in 2007. At 2.9%, the payment on a $340,000 house is actually lower than what he's paying now. He runs it on a calculator at 11 at night on a Wednesday. It works. He calls his guy back in the morning. Here's what the calculator never showed him. Every 30-year mortgage front loads its interest the exact same way, no matter what the rate is. In the first year of any new loan, 75 to 80% of the payment goes to interest. 10 years into his second mortgage, that ratio had finally started tipping the other way. More principal than interest for the first time. The loan was actually shrinking. A refinance doesn't lower that cost. It resets the clock back to year 1 and restarts the whole front-loaded machine from scratch. Tyler is 44 years old. This new loan doesn't finish until 2050. He'll be 74. The rate went down. The debt went up. The industry calls this leveraging your equity. What it actually is a very efficient way to stay in debt for the rest of a working life. Next door, the fall of 2020 is quiet. The 2.9% headlines come through the same way they come through for everyone. But the number tells a different story. The remaining balance is under $35,000. 15 years of that same $150 a month has done what compound math does when nobody interrupts it. No refinancing, no resetting, just a number getting smaller every month and doing absolutely nothing else, which turns out to be the entire strategy. If you want to see how this plays out for someone closer to your own situation, tell us in the comments and we'll walk through it in a future video. It's 2026, 21 years from that Tuesday with the coffee cup. Both men are 50 years old now, same age, similar income, same general stretch of highway between their two front doors. From the outside, the two lives look close enough to call even. They are not. His remaining mortgage balance is approximately $18,000. 21 years of $1,139 a month, plus $150 extra every single month without missing one, turned a $190,000 loan into something he could pay off from savings this afternoon if he wanted to. At his current pace, it's gone within 14 months regardless. When that last payment clears, his housing cost drops to property tax and insurance, somewhere around $300 a month, and the $1,139 that's been leaving his account for 2 decades doesn't disappear. It redirects, the same quiet way the $150 did back in 2005, straight into a low-cost index fund. On a Tuesday, with no announcement, and nobody outside that bank account will ever know it happened. Tyler still owes approximately $252,000 on the house he refinanced into in 2020. That loan doesn't finish until 2050. He is 50 years old with a mortgage that will outlive his career. The house is genuinely nice. The neighborhood is everything he wanted twice over, and he will be making a payment on it every single month until he's 74. The two moves alone, the sale in 2010 and the refinance in 2020, cost him somewhere between $34,000 and $45,000 in fees that never became anything. Not equity, not a house he still owns, just commissions and closing costs on their way to somebody else's business. If that money had gone into an index fund in 2010 instead and just sat there at the market's actual average return over the last 20 years, it would be worth somewhere between $300,000 and $400,000 today. Tyler didn't lose that number by making one bad call. He lost it by making several completely normal ones, at moments that each felt reasonable on their own. That's the part that makes the reset tax so expensive. It never once feels like a mistake while you're paying it. Neither man is behind on a payment. Neither has missed one, ever, in 21 years. That's what makes the gap so hard to see coming. It was never about who paid on time. It was about which one of them kept resetting the clock, and which one just let it run. If any of this helped make something clearer than it was 20 minutes ago, send it to someone who's about to make one of these calls. He drives past Tyler's first house on a Tuesday afternoon in October, the one with the linoleum, the one Tyler sold in 2010. He wasn't planning to. A fender bender rerouted his navigation through the old block. The beige paint is gone. Someone repainted it dark green with white trim. There's a basketball hoop in the driveway now, the adjustable kind, tilted slightly to one side. And in the front left corner of the yard, there's a tree Tyler planted the week he moved in. A $14 stick from a hardware store that barely looked like it would survive its first winter. It's taller than the roofline now. It shades half the yard. It did all of that without him. Tyler left. It stayed. It belongs to whoever lives there now, which is not him. That's the whole shape of the reset tax, in one front yard. It isn't the fees on a settlement statement. It's every year of compounding that never got the chance to happen, because the account it was compounding in got sold before the tree had time to grow. Somewhere there's a version of Tyler's life where he never made that call in the spring of 2010, where the tree in this yard is his, where he's the one who forgot about it while it quietly turned into something enormous. That version of him is standing in his own driveway right now, not this one. He sits in the car a moment longer than he means to before pulling away. He is still in the first house. He is weeks from a mortgage that has never been reset once, still running on the original terms from that original Tuesday. He drives a reasonable car. He takes one vacation a year. Nothing about his life gets photographed for how impressive it looks. Tyler has no idea how close he is, because nobody who does this ever announces it. In a few months, over $1,100 a month that used to belong to a bank is going to belong to him instead, quietly, the same way everything else in this story happened. Not the moving up, not the bigger kitchen, just the years, left alone, doing what years do when nobody interrupts them. If staying on top of decisions like this is something you want more of, subscribing keeps these coming, new ones every week. 2 men, 1 street, 1 nail. Not a bad decision on either side. Most of this was never one bad decision. It was several reasonable ones, made on ordinary days. Each one easy to justify in the moment it happened. The upgrade that made sense. The rate that was too good to pass up. The kitchen that finally felt like his. Every one of them was normal. None of them was free. Somewhere in your own life right now, there's a nail in a wall just like this one, already deciding something, whether you've noticed it yet or not.